Hey everyone, ready for another deep dive? Today we're taking a look at some potential stock picks for March 2025 and beyond, based on an article by the Smart Investor called Four Stocks to Buy in March 2025, a long-term investor's perspective.
Sounds interesting.
Yeah, and get this analyst actually puts their money where their mouth is and invests in the companies they recommend.
Oh, wow. That's always a good sign. So are we talking short-term trades here or long-term holds?
Definitely long-term. Think of this deep dive as your cheat sheet for navigating the stock market with a focus on growth, value, and maybe even some dividends along the way.
Okay, I like the sound of that. And did you say one of these companies is even predicted to hit a $1 trillion market cap?
You heard that right? Want to find out which one?
You bet. Let's dive in.
Okay, so first up is Elf Beauty, ticker symbol ELF.
Elf Beauty, huh? Like the drugstore makeup brand.
Exactly.
Interesting. I wouldn't have thought of them as a huge growth opportunity.
I know, right? You might be thinking, wait, the drugstore makeup brand? But don't let that fool you. They have serious growth potential.
Okay, I'm intrigued. What makes them so special?
Well, for one, their products are usually priced between like $5 and $12.
Oh yeah, that's definitely affordable.
Right, and that makes them accessible to a really wide range of consumers, even in tougher economic times. Plus, they've proven to be incredibly resilient.
Resilient.
Yeah, they navigated those Trump-era tariffs like it was nothing and even thrived during the 2020 pandemic downturn.
Wow, so they've been through a lot and come out stronger on the other side.
Exactly. And the analyst is predicting their revenue could grow by 15 to 20% annually, with net income growing even faster.
Those are some really solid numbers.
Yeah, their most optimistic prediction, what they call their bull case, puts ELF at $272 per share by 2028.
$272. That's amazing. What kind of return are we talking about?
Oh, it translates to a 34 to 44% compound annual growth rate, or CROGR for short. It's basically how much your investment grows on average each year.
Okay, so even if they don't quite hit that super optimistic target, they're still looking at some pretty great returns.
Right, even their more cautious prediction, their bear case, still suggests a profitable investment.
So buy and hold, huh?
Potentially, especially at their current price, they're a real gem.
Okay, I'm writing this one down for sure. What's next?
All right, buckle up for this next one. We're talking about advanced micro devices, or AMD.
AMD? Oh yeah, I've heard of them.
And get this, the analyst thinks they could reach a $1 trillion market cap within the next 5 years.
Whoa, wait a minute. $1 trillion. Now that's a bold prediction.
I know, right? But it's based on some pretty exciting stuff they're doing in the artificial intelligence and semiconductor markets.
Yeah, those are hot markets right now.
You bet. Specifically, their new MI350 and MI400 chips are generating a lot of buzz.
What makes these chips so special?
Well, for one, they're going head-to-head with NVIDIA in the data center and AI chip markets.
Oh wow, taking on the big guys.
Yeah. And they're winning too, because these new chips offer significant performance improvements, especially for all those complex calculations needed for AI.
Plus, I'm guessing they're more energy efficient too.
You got it. They use less power, which is a big deal for those huge data centers trying to reduce their energy footprint. And on top of that, AMD acquired a company called ZT Systems, which specializes in those really powerful computing systems.
So they're not just making the chips, they're also helping build the infrastructure for AI development. That's a pretty smart move.
Exactly. They're covering all the bases, and the analyst is so bullish on AMD that they're buying shares every single week.
Every week. Wow. They must really believe in the company's future.
That's definitely a big vote of confidence. Of course, the tech industry can be unpredictable, so there are always risks involved, but AMD is definitely one to watch.
For sure. So two very different but potentially lucrative picks so far. What else do we have?
Okay, how about something a little more refreshing? Let's talk about Celsius Holdings, or CELH.
Celsius. I think I've seen their energy drinks at the store.
Yeah, they're making some serious waves in the energy drink market.
Cool. I'm always up for trying new drinks.
Well, they hit a bit of a snag recently because of some inventory adjustments after their huge distribution deal with PepsiCo.
Oh, so that's why their stock might be down.
Exactly. But before you write them off, remember, this is probably just a temporary setback. Their long-term growth still looks really strong.
Okay, that's good to hear. What's their secret?
Well, they've built a loyal following with their focus on healthier energy drinks Low sugar, natural ingredients, that sort of thing.
Yeah, that's definitely a trend that's here to stay. People are more health conscious these days.
Right, and they're not just sitting around waiting for things to turn around. They've been busy acquiring Alani Nutrition, a female-focused energy drink brand that's gaining popularity.
Smart move. Expand their market, reach new customers.
And they brought in a new chief operating officer with tons of experience from PepsiCo, someone who really knows the ins and outs of large-scale distribution.
So they're setting themselves up for success.
Absolutely. And here's the kicker for investors. The stock is currently trading below its pre-Pepsi deal price.
Oh, so it's like getting a discount.
Exactly. It could be a fantastic entry point for anyone who believes in Celsius's vision.
That does sound tempting. Okay, what's our last pick for this part of the deep dive?
Okay, let's talk about a brand everyone knows and loves. Cheesecake Factory, ticker symbol cake.
Cheesecake Factory. Now, that's a name I recognize.
Yeah.
Who doesn't love their huge menu and those over-the-top desserts?
Exactly. But here's something you might not know. Their growth isn't just coming from those iconic restaurants.
Oh, really?
Yeah.
What else is driving their growth?
They're North Italia and Flower Child brands. North Italia is more of an upscale Italian dining experience, while Flower Child is all about that fast casual, healthy vibe.
Oh, yeah, Flower Child. I've heard of that. Fresh, farm-to-table ingredients. Right.
Right. They're planning to open 25 new locations across both brands just this year.
Wow, 25 new locations. That's a lot of expansion.
And their long-term goal is to have over 700 Flower Child restaurants.
700. That's a whole lot of flower power.
Right. And to show they're serious about this expansion, they recently offered $575 million in convertible notes.
Convertible notes, so basically loans that can turn into stock. Right.
Yep. It's a pretty clear sign that investors have confidence in their future.
And with those new brands taking off, their valuation seems pretty attractive too.
Right. Their price-to-earnings ratio, or PE ratio, is only 15.
A PE ratio of 15. That sounds pretty low compared to some of their competitors.
Exactly. Competitors like Texas Roadhouse have a PE ratio of 25, and Chipotle is at a whopping 44.
So they could be undervalued right now.
It's definitely a possibility. I mean, it's a brand everyone knows and loves, and if their new brands continue to be successful, they could be onto something really big.
It's definitely one I'm going to have to research further.
Me too. So we've covered 4 of the analysts' top picks so far, from beauty and tech to energy drinks and restaurants. But the smart investor also included a couple of bonus picks for those who are a little more, how we say, adventurous.
Bonus picks. You got me hooked. Tell me more.
We'll dive into those after a quick message from our sponsors. Stay tuned.
Welcome back. Before we jump into those bonus picks, I think it's worth pointing out something interesting about all the companies we've talked about so far.
Oh, what's that?
Well, they all seem to be really good at adapting and innovating.
You're right. Whether it's e.l.f. Beauty embracing e-commerce, AMD pushing the boundaries with AI, Celsius hopping on that healthier energy drink trend, or even Cheesecake Factory with their new brands.
Yeah, exactly. They're all finding ways to stay ahead of the game.
Which is super important when you're thinking about investing, right?
Absolutely. You don't just want to look at what a company's doing now, but also what they could become in the future.
So it's not enough to just ride the current wave. They need to be shaping the future of their industry.
Exactly. Companies that can anticipate and adapt to change are the ones that are most likely to succeed in the long run.
So it's about understanding their growth strategy, their vision, and whether they can actually make that vision a reality.
I like to think of it as investing in a company's story, not just their current financial snapshot.
Ooh, I like that. It's about seeing the potential, the narrative that unfolds over time.
Exactly. And speaking of potential, that brings us to those bonus picks companies that might be a little more, shall we say, speculative.
Okay, let's hear it. What are we dealing with?
Well, first up, we have The Honest Company, trading under the ticker HNST. They're currently priced around $5 a share, which might make them seem like a bargain.
$5 a share. That does sound tempting. What do they do?
They focus on clean and sustainable products for babies, families, and even pets. They built a strong brand reputation for being transparent and ethical. They were a bit of a market darling when they first went public.
Yeah, I remember hearing about them. But haven't they had some challenges lately?
Yeah, they did face some controversies with their product claims and labeling. It definitely had an impact on their stock price.
That's understandable. Have they bounced back from that?
Well, they've been taking steps to address those issues. They've been reformulating products, strengthening their commitment to transparency, and even expanding into new markets like personal care and beauty.
So there's potential for a turnaround.
Potentially, yes. They've got a strong brand, loyal customers, and they're taking steps to correct their mistakes.
Okay, so for an investor with a higher risk tolerance, the honest company could be a good bet.
Exactly. It all comes down to whether they can regain consumer trust and make their growth strategy work.
Okay, interesting. What's the second bonus pick?
The second one is Fubo TV, trading as FUBO, and it's currently around $2.84 per share. They're a streaming platform that started out focusing on live sports.
Streaming is so competitive these days. What makes them stand out?
Well, they're trying to become more of a one-stop shop for all your entertainment needs. They've made deals with big media companies like Disney and Warner Bros. Discovery so they can offer a wider variety of content.
So they're not just about sports anymore.
Nope. Movies, TV shows, news channels, they're trying to compete with the big guys like Netflix and Hulu.
Wow, that's ambitious. But are they just trying to be everything to everyone? What's their real strategy here?
Well, one of the most interesting things they're doing is partnering with FanDuel, the sports betting company.
Wait, sports betting? That seems like a completely different direction.
I know, right? But it's a market that's growing like crazy, and Fubo TV wants a piece of it. They're letting viewers place bets on live games right in their app.
So they're blending entertainment and gambling. That's a bold move.
It's definitely a risky move, but it could pay off big time. They're targeting those die-hard sports fans who are already watching the games, and they're giving them a seamless experience. It could be a real game changer, but it's also a gamble.
That's a good way to put it. So we've got two bonus picks here. The Honest Company, a potential turnaround story, and Fubo TV, a streaming platform making some bold moves into entertainment and sports betting.
And it's important to remember these are higher risk investments.
Right, not for the faint of heart.
Exactly. But for investors who can handle a little more volatility and believe in the long-term potential of these companies, they might be worth considering.
Okay, so we've covered a lot today, from established companies like Elf Beauty and Cheesecake Factory to those more speculative picks like The Honest Company and Fubo TV. It's been fascinating exploring their stories and their potential for growth. But stick with us, because after the break, we'll wrap things up with some final thoughts and key takeaways to help you on your investment journey. And we're back. Man, I don't know about you, but I'm feeling pretty inspired after hearing about all these companies and their innovative ways of approaching things.
Yeah, it's exciting seeing companies really pushing those boundaries and finding those new ways to create value, right?
It is. But I imagine some of our listeners out there might be feeling a little overwhelmed right now.
Oh, yeah, probably.
We did cover a lot of information about 6 different companies, all in different industries.
That's true. It's a lot to take in.
So what's the most important thing for listeners to remember?
I think it's that investing isn't about chasing every hot tip or trying to perfectly predict, like, the next big winner.
Right, right.
It's more about making those smart, informed decisions based on, well, your own goals, your own risk tolerance, and how long you want to invest for.
Your time horizon, right?
Yeah, exactly. And that's where the real work begins.
So this deep dive is just the beginning.
Pretty much. Think of it as, a spark, some ideas, and an introduction to companies you might not have known about before.
I love that. A start. Okay, so where should listeners go from here? Like, what can they actually do?
Well, first things first, do your own research. Don't just take our word for it or just rely on one article.
Right, go deeper.
Exactly. Explore company websites. Read financial reports. See what different analysts and investors are saying. Get those different perspectives.
It's like being a detective, putting all those pieces together.
Yeah. And don't be afraid to ask questions. There's so many resources available, like online forums and educational websites.
You can even talk to, like, a financial advisor if you want that more personal advice.
Right, definitely. But I think, most importantly, remember that investing is a marathon, not a sprint.
So patience is key.
Absolutely. Don't get caught up in all the hype and those short-term ups and downs of the market. Focus on building that diversified portfolio, spreading your investments across different companies and industries, and then just give it time to grow.
And who knows, maybe you'll discover your own hidden gem in the market. Right?
Exactly. That's the beauty of it all. There's always something new to learn and something new to explore.
So as we wrap up this deep dive, any final thoughts for our listeners?
I think a good question to ask yourself is, out of all the companies we talked about today, which story really stuck with you? Which one really resonated with you?
And why?
Yeah, why? Take some time to really think about what you learned, what excites you, and what just feels right, based on your own values and financial goals. Because at the end of the day, the best investment is the one you truly understand and believe in.
Couldn't have said it better myself. Thanks for joining us on this deep dive into the world of stock picking.
It's been fun.
And remember, the journey to financial success starts with a single step.
Until next time.
Happy investing, everyone.